Hello, good morning. It's Monday the 28th. I'm FX Plu for a month-end market brief. So the end of COVID season in the UK, that passed with relatively little fuss. Attention quickly shifted to inflation, higher bills and higher taxes. But last week, all that paled into insignificance as Russia invaded Ukraine and everything changed once again. The effect is still a tricky one to call, but no doubt lower growth will feed through to pretty much every developed nation. BP has been on. They will offload the 19.5% stake they held in Russian oil company Rosneft, commenting that the decision had been taken amid unprecedented political pressure. So just in case any shareholders are more concerned about dividends than deaths, BP's message was, Boris made us do it. Classy stuff. A bunch of sanctions have been imposed already, but possibly the most significant will be the exclusion of Russia from the SWIFT network for international payments. SWIFT has been around since 1973, and while it is painfully apparent within some payment corridors, it has managed to keep pace as the primary payment network for nearly 50 years now. While the establishment find it hard to see how Russia will work around this, perhaps this is exactly what all the crypto lot were banging on about, lording up a decentralised currency. Not quite sure this is the use case they had in mind though, so there's a lesson there. Be careful what you wish for. Several cyber attacks have been credited to Russia so far, and there is concern about state-sponsored activity. So while the financial markets are beefing up their infrastructure security, remember to do your bit as well. Don't open any unsafe attachments. Back in the day, loose lips sink ships, but nowadays, careless clicks cause chaos. Pithy stuff. The UK calendar is rather bereft of data this week, so the Ukrainian crisis will be the only real driver in the market. Sterling saw 134.40 against the dollar on Friday in pretty volatile conditions where risk appetite is driving trade. We open at 133.65 against the dollar this morning and 119.70 against the euro. Oh no, I've got my dog. The US is facing up to the fact that a nuclear deterrent is only really effective if you are prepared to press the big red button. Putin ignored the combined arsenal of the West and instead made pretty chilling threats to any nation that tried to halt his ambition. Biden is being made to look rather weak in comparison, as there's nothing Washington can really do in the short term. Knowing a traditional reaction is pretty unlikely, Putin has stolen a march on NATO. So aside from sanctions and global condemnation, will the West just watch Ukraine be engulfed back into a 21st century version of the Soviet Union? Well, we'll wait and see on that one. Back stateside, growth is expected to be adversely affected by the conflict, but this week may be important as Powell is due to testify on Capitol Hill about the country's economic position. He won't go as far as to confirm either the date or the size of any tightening of monetary policy, but it's clear that they will vote for a rate hike at the next meeting. And the markets are coming around to the idea that the first rate hike will be 50 basis points, and many are also leaning into a second 50 basis point hike, while economists, however, are slightly more concerned that such action will slow the economy potentially to the point of recession. We have non-farm payrolls on Friday, following the upside surprise which caught all the sweepstakers off guard last month. The February data is eagerly anticipated at the moment. Current forecasts are for around 425,000 new jobs to be created. And last week, with the falling risk appetite, we saw the dollar index helped up to 97.75, and euro dollar starts the new week from 111.65. That's it from me. Join me again tomorrow.
If you do not have a clue, then just tweet through and ask FX Blue.